And you went with action.
All right, good morning and welcome back to the Money Advantage podcast. I think we're live. We ought to be live. I presume we're live. Here we go. All right, we're diving in today. Bruce and Joe, thank you for joining me. If you are listening to this podcast today, we're digging in, diving in, going deep on this topic of mutual versus stock versus mutual holding company. So, if you are new to the idea of infinite banking, this is something that can potentially cause confusion. If you've been in the space of infinite banking for a long time, this could also cause confusion. So, what we're doing today is helping you understand really what is a mutual company, what's a mutual holding company, what's a stock company, and really be able to help you as a policy holder, policy owner, be able to understand the contract that you're making with a life insurance company and really how the status in terms of being a mutual holding company or a stock company impacts you in terms of strength and long-term guarantees. And so, Bruce and Joe, I'm really excited for you guys to join me today because this is an issue that I think really needs a lot of clarity, and we love to be able to bring that clarity to people who need to make decisions in a world where there's all of this information and then people have opinions and they talk about those opinions, and it can be difficult to sort out what really matters and how to make decisions that are healthy in your own financial life. So thank you both for joining me so much today.
Rachel, I think the intent of this particular podcast is to bring some clarity. And first of all, I'd like to bring some clarity that your behavior of how you implement the infinite banking concept is much more important than whichever company you're using. These companies have been around for 120 plus years, in some cases, 150 plus years. And so people kind of wring their hands all the time and they're worried about picking the correct company. And Nelson even said it himself that you can do this concept with a variety of financial tools. It just so happens that a mutual insurance company just happens to be the best tool to do it. So your behavior is actually what's dictating this. So what we're going to do today, because there's a lot of people out on the internet now that are trying to claim that one company is better than the other company, and you should use this company because of this, or don't use that company because of that, you know. And we have an opinion. We're going to try to just give you the facts, and then you can make a decision on the entire thing. Because it's interesting. Social media is trying to grab your attention, and everything's marketing, including the insurance companies. Okay, the insurance companies are also marketing a certain way, so you should also take that with a grain of salt. But to give you a little background, I started my first policy for my father with Western Southern Life back in 1963. My second policy was with Franklin Life. My third was with Franklin Life. And some people may say, well, Franklin Life, I've never heard of them before. Well, that's because they actually demutualized in the early 90s. I still have that policy. Okay. It still pays the interest. It doesn't pay the dividends, but it's such a seasoned policy that it works very, very well. I'm not going to give it up. And that is the final thing I'd like to kind of do as an introduction is, unfortunately, there's people out on the internet that are telling people they have the wrong company. So you need to change that company and go with another company and do what's called the 1031 exchange. And I'm sorry, 1035 exchange. I would get my real
Bruce,
estate
I always
in that.
mix those up. It's 1030 something exchange.
Yeah, 1035 exchange. Sorry, we do 1031 exchange with our investment company. So I got that mixed up for just a second. 1035 exchange. And that is the absolute, in my mind, I don't make these statements very often. That is the absolute wrong thing that anybody could be doing, because a mutual company that you have, whether it's a mutual company, a mutual holding company, and in some cases, even a stock company that's matured for a while, you should not be replacing those, because you are doing a couple things. You're changing the mortality. You're also changing the liquidity. You start it all over a situation. So let's just keep all those things in mind as we talk through this.
Joe, at the top of this conversation, can you weigh in just on your thoughts on this whole conversation, why it matters, and really what we should be focusing on today?
Yeah, sure. So I think two thoughts come to mind. First, with the different types of company, if we're looking to implement the infinite banking concept, um, the idea of earning profits, earning dividends is can be a huge benefit. And if we can, we want to capture that. And Nelson, in his book, tells us, we want a participating or dividend paying whole life policy. That's the best platform to do this from. Um, and that's not saying all stock companies don't pay a dividend, but you'll Bruce will show that you're serving two masters with a stock company. So they're dividing the divisible surplus between stockholders and policyholders. If we can, we might want to capture all of that. It's probably in most scenarios for this purpose beneficial to capture all of the profitability versus sharing that with stockholders. Um, the other the other idea here is a mutual company. It might be foreign to a lot of people. So if you can think in the back of your mind, think we're talking about almost like a partnership arrangement, loosely speaking, a partnership arrangement versus a corporation arrangement where there could be different classes of shares of ownership with different rights and different privileges. Over here, there's not. It's this is the benefit being limited liability, limited exposure over here versus not. You're kind of all in this all together, working together, rowing the boat in the same direction for the long haul versus different people can have different priorities, and those priorities can pull the direction of the company in different directions. Um, so I guess if you can keep that in mind, we're comparing those type of structures together. And what Nelson was saying is if we can use if we can capture all of the profitability, it behooves us in the long run. It will improve our financial personal economy.
Mm, that's so wise. Okay, so for the beginning of this conversation, if we could maybe draw mentally a continuum, and we have on one side a mutual company, and we have on one side a stock company. Let's just get really clear. So, Joe, you've kind of talked about the benefits of either, but whichever one of you guys wants to really just articulate the bottom line with this, but stock company versus mutual company, what is the difference in terms of how that treatment is to you, the policy owner?
So you were on a roll there. So
How about I'll take stock and you can have the mutual. We'll
okay,
divide it up. So I think stock. What the characteristics there? It's an activity. The company is has an activity that's profit seeking, as defined by the IRS. Otherwise, it'd be a hobby. So it's profit seeking, and then with those profits, it distributes them to the owners of the company first. The owners of the company are the shareholders first. And then from there, if there's anything left, it might distribute to other causes. So in this case, policy owners. So the lion's share of the profitability of that year's operations will go to the stockholders. Um, the types of dividend might also be different. So in a stock company, they will declare a stock dividend, so shares of stock. Whereas the stock of a mutual company, you'll find out, is premium. So one of the benefits, which Bruce can talk about, is the taxability here. A stock dividend doesn't get taxed, but there's an adjustment in basis, meaning when you go to use those in the real world and spend, like liquidate them to spend them, it's a taxable event. Whereas over there, Bruce has the benefit on this one. Not so much on a mutual company and with a mutual life insurance and a policy there. So there are dividends. They're probably not as large. The status and type of dividend is different. But to Bruce's point, if you have a seasoned policy, you can still bank from it. There's still a loan provision. There's still certain contractual guarantees where the policy values will increase over time. So there could be a cause to keep that policy if it is seasoned enough and performing.
And so,
Yeah,
based on
very
kind of
good.
what you're saying, Bruce, with being seasoned, if you already have a policy that you've had for a period of time, you've already gone through the lack of liquidity, you've gone through the capitalization phase, and you've held it for a while, and you're not necessarily getting as much on the dividends, you still have the guarantees of the death benefit on a whole life policy. You still have the guarantees of a minimum cash value, and you still have the guarantee of a premium, which means you're not going to have a premium that requires additional pay in order to keep those ends of the contract. So they will uphold the death benefit and the cash value as long as you are upholding your premium. And so there's still a benefit in that policy. You still have those guarantees. It's still a whole life policy. It still endows. You just have a little bit less funneling towards you in terms of the insurance company's profitability. Bruce, is there anything you want to clarify or recapture on the stock side before we move over to
Well,
mutual?
one thing you just have to consider is there have been two CSO changes since the 90s. And I looked at mine because I got it at such a young age. I was in my mid 20s that the mortality, even though the tables changed and I had it for such a long time, that it didn't make any sense. You can do an analysis to see if you can gain death benefit even at your increased age. But that's a simple analysis. But just to do it just because you're saying, well, I'm not going to get any more um, dividends, or you're going to get a less of a dividend, as Joe said, is not a reason to do it. You have to do an analysis on the whole thing. And there, you could have some other provisions that were on there, like convertibility of, a term that you now have locked in for the entire term of that, which could be very valuable. You might have waiver of premium on there that maybe it's much more less expensive than if you have a new policy because you started it at a younger age. So there's a lot of different things that you need to consider with when you're trying to evaluate a stock company. But just to say blanket, oh, you got to get out of it. I vehemently disagree with that situation. There has to be an analysis on it.
So
So
would it
with
be
the
fair to say then, Bruce, if you have a current whole life policy, I mean, we've already said on the show that Nelson Nash said the best life insurance policy to have is the one that's enforced when you are on the day you die. So that's the best life insurance policy to have. I would say the second most important thing to have with a life insurance policy would be the one that's been, especially a whole life policy, the one that's been enforced the longest is probably going to give you more
right,
benefit than the one that you just started yesterday. So
very good.
okay, so we've kind of clarified what the stock company is, and now we're going to the complete opposite end of the spectrum on what is a mutual company, what makes it a participating life insurance company, and how does that benefit the policy owner?
Yeah, so mutual companies have been around for a couple hundred years, and it basically is like a lot of things that people might understand, like farmer co-ops or a mutual farming grain company or fertilizer company, so on and so forth. And it's just pooling your resources. So policyholders are pooling their premium resources with a central entity, that company, and that company is responsible to the policyholders, to no one else. So you cannot buy stock in that company and to benefit from it. You have to have a policy. And so just like we've said and I'll recap this, we've said on the program a bunch of times, is you're going to have expenses through the company to run the company. You're going to have expenses from mortality expenses, death. That's the biggest one. And then you're going to have profits from the investments from the chief investment officer. And they're going to try to keep expenses as low as possible by good underwriting. Plus, the company is well run. They're looking at every nickel and dime because they're being upheld by the policy holders who are owners. So they're looking at the company. What are you doing with our money? And then at the end, then the board declares the profit And then they take some of that profit and they put it back in the form of reserves. And the rest of the profit, they actually declare a dividend to be credited proportionally to every policyholder. And so the policyholders then are reaping all the benefits. There's nobody outside that doesn't have a policy that's reaping the benefits. So
And that's a
then to
huge
participate,
advantage
yeah,
because you're then earning the dividends as a dividend is declared. In my participating whole life insurance policy, the dividend is
that's where I was,
declared,
yeah, that's why I
and
was just going to
then
go.
that is paid out,
Very good.
and I get to experience not only the interest rate increase, but also the dividend increase of my cash value. Go ahead, Bruce.
Yeah. No, go ahead, Joe.
Yeah, I just wanted to so I forgot to mention this on the stock company. Stocks, when stock dividends are declared, or with a regular company, it's proportionate. Meaning, if you have 100 shares, they're going to say the dividend per share, the dollar per share that you're going to receive. In a life insurance company, that's not a mutual life insurance company. It's not proportionate. It's based on the contribution principle. It's based on the profitability of the block of business. It's based on it's not as simple as I paid $1 premium or I have $1 death benefit. I get to multiply that by some cents, and that's going to be my dividend. It's kind of like a black box mystique to it that only the actuaries know. For each company, it's different. Only the actuaries know how they declare the dividend and how they credit it. It's not as a blanket statement as like you can look at Apple and say it's a 3 cents per share dividend. Um, just wanted to clarify.
That's
Yeah,
really
Joe, that's a
good.
really good, yeah, really good point. Although it's going to be difficult to get into that
Yeah.
aspect of it because they're tranching off or blocking off different segments of business, different products along the way. And when they started those products, the economic environment was different for the bonds at that time, mortality costs at that time. So every one of them is tranched off a little bit. So the declared dividend is actually proportioned out differently. So that's why we tell everybody you can't just take the dividend, multiply your cash value by the dividend, and then you're going to get that increase. That's not how it works.
And
And
another
as
way
Joe's,
it doesn't work is by taking the illustration that has a projected dividend in today based on today's dividend rates, and that illustration is going to project that same interest rate or dividend rate out for every year of the policy, and that also may fluctuate over time because, and this is something we talk about all the time, but illustrations are not a guarantee of future performance. And it's something that's a snapshot in time based on today's environment. So there are a lot of components of the dividend that are moving pieces. The thing that is guaranteed though is that if you're within a mutual company, you will be paid out the profitability of the company. And it also is true that the companies that are mutual companies have been paying out dividends in every year since the beginning of their life, even through the worst of economic times.
Well, Rachel, they're not guaranteed, as Bruce said, and Rachel just kind of highlighted again. It's not dividends are not guaranteed, but they're engineered. Like the actuaries can't make a mistake, so they have to build in a safety buffer, and part of that safety buffer ends up being the reserve for the dividends. We don't know what the size of the dividend. We can't really project out in the future. Um, they're not guaranteed, but they're engineered into the equation because of the margin of safety that actuaries have to take. They have to do it. Otherwise, they won't be in business.
Absolutely.
and
Go ahead, Bruce.
once declared, those dividends now become guaranteed.
Which
And
is
the great part of,
wonderful.
and then you actually get dividends on the dividends into the future. So that's where you get the compounding. So before we go into what a mutual holding company is, I'd like to say the different agents at the Money Advantage are contracted with 4 different mutual companies out there. Our philosophy is that we would like to do business mostly with one company for a variety of reasons. And I've already said that they're all basically the same. So, you're not getting a big benefit from one company on another. You might get a specific benefit from one that you will need every once in a while. But the reason I like to have one main company is you get to know their products really well. You get to know their personnel really well. You get to know their designs really well. Those can really benefit a client for a variety of reasons. You need to have other companies, though, because other companies may have slightly different underwriting guidelines. They may have a product. One of the companies we use has a product that when you RPU, or reduce paid up, we don't have enough time in this to go over what that is, but when you reduce pay up, their chronic illness rider does not go away. It just adjusts. We have other ones that could have a situation where their rates seem to be a little bit better for younger folks. So you're just tweaking it, but having a company that you mainly do business with, there's a lot of advantages. This whole thing about being a broker with 30 different companies sounds great, but you never develop relationships. You never delve into one company really, really well, which we think is a great advantage for our clients.
Bruce, I
So
love
would you
that you
like?
mentioned that. Yes,
Okay,
go
good.
ahead into, I think the next question then, especially on the mind of somebody who's trying to gather all the information and listening and reading books and pursuing as much knowledge as they can, is that there's this other term, this what seems like some middle ground of mutual holding company that causes some amount of confusion. What is that? What are the ramifications? How does that work? And so, Bruce, I'm just going to primarily turn it over to you for talking through what that is. And I know you have some stuff to share on the screen as well. So if you're listening, please stay tuned and jump in with your questions as well in the comment section if we can answer those live.
So the next kind of corporate structure, although it's not a total corporate situation, but the next business structure is a mutual holding company that was designed so that a mutual company could actually merge with a non-mutual company, but still hold its mutuality. And if we look at this right here on the screen, and I'll describe it to people that are just listening right now, it's actually a brochure called What is a Mutual Holding Company? And I'm not going to read everything, but the mutual holding company form of operation evolved to allow mutual companies access to the capital markets through their stocks subsidiaries and to facilitate mergers and acquisitions. There are people out there in social media right now that are saying anybody that becomes a mutual holding company, the only reason they're doing it is because they're in financial trouble and they have to raise capital to get out of the financial trouble. What's interesting about this is I think this is really important because they're trying to make it look like the stock company is actually rating some of the profits of the mutual company. And it
And
says a
you mean
stock company
RAID, not rating like as in scoring, but you mean like stealing, rating, like looting.
rating, yes,
Yeah.
rating, rating, rating the profits of the mutual company. A stock company cannot own a mutual company. Thus, the mutual holding company allows companies, and here it is, that formerly operated as a mutual company to retain its mutuality while also having the potential to raise capital. Okay, so the next line, policyholder protections remain in place. So we normally try to stay agnostic when it comes to companies, but we are going to say that this has been talked about with Lafayette Life, who is one of our main companies that we use. And I've actually talked to some of the heads of Lafayette Life, and they're aware of these disparaging remarks about a mutual holding company. But I like to just bring in some facts here. The first fact is that Lafayette Life became a mutual holding company before it even merged. So they didn't do it out of some desperation. And by the way, they did it 25 years ago. They did it in the year 2000. So they did it in the year 2000 because, as these people are saying on the internet, that they were in some kind of financial, you know, distress, and they were going to demutualize. It's been 25 years of now financials to actually look at to see how they've just become stronger and stronger. The second thing is they did merge then with Western and Southern, and they did call it a merger. It wasn't an acquisition in June of 2005, which means they've been merged now for 20 years and haven't demutualized. Both companies actually benefited. So if I bring up now, I'm going to stop sharing this one. I'm going to bring up now. Go ahead,
Go
Joe.
ahead, Joe.
Yeah, I just wanted to maybe people might not understand what it means to have access to the capital markets and why a company might want that. I just kind of wanted to explain what that kind of means. Whether it's stock or a mutual company, um, to gain access to the capital markets is a way of saying we want to expand for something. We just take any old company. We want to expand our operation and buy a new location or something, set up a new location to operate our business. But we don't have the money today. What can we do? There's really two promises a company can make. They can promise future cash flow or future appreciation. And when you promise future cash flow, that's a way of saying they'll issue debt, is probably the more fancy way of saying that. They'll give you a bond and say, we'll pay you some amount of interest over time. And then at some point, we're going to pay back the principal as well. Or we'll say, hey, we'll give you a part of the ownership so that as it appreciates, you'll get a proportion of some profitability over that timeline. And when you want to sell, you could sell it back to us. You could sell it to somebody else. It's the transaction's done. So accessing the capital markets just means raising some type of capital or money to go do something in your business. And the two ways of doing that are promising future cash flow or promising the promise of appreciation. Mutual companies are limited. Traditional mutual companies, 100% mutual, cannot promise the appreciation piece. They can't give shares out there, sell shares to raise capital, but they can issue debt, and they can borrow from policyholders and give them a return to go do the expansion or do the investments that they need to do. This combining of both worlds allows the preservation of the mutual structure, but then gives them access to the equity, the appreciation piece, where they can promise appreciation. I hope, sorry if that's a little confusing. I'm trying.
No, Joe, actually, that's just kind of where I was going with this whole thing, because Western Southern looked at the books of Lafayette Life and saw that they were well capitalized. They also, by the way, bought Gerber Life several years later because Gerber had really good reserves. What did that do for Western and Southern? On their books, even though there's a wall between these companies, they actually now raised up their reserves for the entire Western and Southern financial group, which made them stronger. So it benefited Western and Southern to actually have these two other companies that had really strong reserves. Lafayette Life was in Lafayette, Indiana. I wasn't with them at that time, but I know the president that actually facilitated this merger. And he said to me, the reason we're doing this, excuse me, the reason they did that, because they did it in 2005. The first time I met him was 2009. Said the reason we did it, we were in Lafayette, Indiana, a very small place. We couldn't attract the top people to come to Lafayette, Indiana to work. And we had antiquated computer systems that we did not have the capital that we wanted to rob from our reserves to actually build up those computer systems and the operations and so on and so forth. So they merged with them, and Western Southern was glad to merge, and Lafayette was glad to merge because they had access, like you said, Joe, to more capital for their computer systems. And now Lafayette Life and Columbus Life, which is also part of Western and Southern, have merged their operations along with Western and Southern. So they get economy of scale with all these operations. So that's what they did. And I just on the screen, the NAIC and the rating companies have put this out, and it just so happens that now Western Southern Financial Group has the highest rating of asset to capital rating in all the industry. And the 5-year average return on capital is the highest in all the industry. So we're talking about a financial group that is very, very strong, very, very strong. And so anybody that's trying to raise doubt in this situation is not giving you the facts.
And I just want to, so and for the people watching or even hearing that, they may think of other names that take the top spot or claim the top spot. What they did here is they adjusted for the size of the company. So is to say, based on how much premium you collect or based on how many contracts enforced, what are you doing with those assets, those premium dollars, and how are those assets performing? It's not a strictly nominal ranking to say who's the biggest in the room. We're going to adjust it for the size of the company and the quality of the company, and from there we're going to compare those somewhat relative performances. In that case, Western, yeah, they're right now they're ranked number one.
Yeah, and whenever we're evaluating anything, just like you people listening to this or watching this, you should be evaluating us also. And Warren Barnes has made several comments that are really, really good. He's well versed in the insurance agents in this insurance industry. He said from 1993 to 1995, I was part of a small group of people who executed the demutualization of State Mutual Life, then the third largest life insurance company to demutualize. The company was healthy. My experiences have made me skeptical of demutualization, except when necessary due to the rescue of a distressed company. Warren also says, generally, there are currently other options for insurance companies' capital management other than demutualization or a mutual holding company. And all that's true. What we're trying to say is just like us saying that we don't believe they're demutualizing for X, Y, and Z, another social media post shouldn't be saying that they are going to demutualize. This is the matter of fact, the comment was, this is the canary in the coal mine. They are demutualizing because this is the only reason why you become a mutual holding company. Well, we don't believe that to be true. And the facts are, and also I've attended many of these national conferences for Western and Southern Life and Lafayette Life. I've listened to the CEO of Western and Southern Life. Now he could be, lying to us, and he could change his mind, but all he does is gush about the relationship and the benefits of having this mutual holding company in Lafayette Life. So go ahead, Joe.
I was going to say, and because of the relationship, policy owners hold two types of rights. Like if you're with Lafayette Life, you have the policy owner right, and then the what's it, mutual member right as well with Western and Southern Holding Company. So it would be extremely difficult to unwind that, to break the wall, to raid the coffers, to do yeah, it would be something cataclysmic for the number to be as healthy as it is to go to that extent and demutualize. It just
that's the next part I wanted to bring up. And Warren, thanks for once again commenting on this. Generally, there's currently other options for insurance companies' capital management other than demutualization or mutual holding companies, and we're not going to go into those today. But one of the things I just want to tell people, I don't believe that mutual holding companies is the first step to demutualization, especially as Warren mentioned. That could be the first step if they are not financially healthy. But there are other options, even if they are not financially healthy. However, if we just look at the current ratings of these companies that I have on the screen now, we can see the ones that are very, very popular. Northwestern Mutual is the cream of the crop. They are a great, long-standing mutual company. There are some reasons why, the infinite banking concept utilizing Northwestern Mutual is not necessarily in people's best interest because of a philosophy of the company, not because it's a bad company, but just the philosophy of the company.
Hey, Bruce, just for
Guardian,
somebody who's not able to see what we're saying, who's listening to the podcast later, Bruce is showing a chart that includes a company name and then all of the different rating organizations' scores. So it includes AM Best, Standard and Poor's, Moody's, Fitch, and then also the Comdex rating. And so if you are listening to this on the podcast and you want to go get that visual, go ahead and go over to YouTube and grab this video from when we did this live. It might be really helpful for you.
and so just to give you an idea, the Comdex score is a amalgamation of all the rating systems, and with 100 being, the perfect score. And Guardian is next at 99, Mass Mutual's 98, American United Life Insurance Company, which is One America, which is under that network of companies, and then Lafayette Life and One America have the same Comdex score of 95. So the fourth highest rated company from the Comdex ratings. So you can take that for what it's worth. And then the last little thing I'd like to
Bruce,
show.
one thing to point out, so those ratings have to do with, I mean, if you really just boil it down, it's the company's financial stability and solvency. And then all of those individual ratings are composite. It's almost a composite score when you look at the Comdex. So it's kind of an analysis of looking at all the other rating agencies independently and giving a amalgamation score. That's what the Comdex could be seen as.
And just to clarify why this is different, why isn't Lafayette Life number one in this regard? One, we're looking at Western and Southern compared to Lafayette, and that the previous slide we looked at, the previous study, was adjusted for size. This isn't adjusting for size per se. It's not starting with that adjustment and then comparing the relative performance. It's just saying the company's books, is it healthy or not? Yes. Is it healthy or not? Yes. Based on the different algorithms each rating agency uses to combine for that Comdex score.
And the final one I just wanted to share, and once again, we want to emphasize to everybody that you cannot compare dividend rates for crediting. Okay. However, in a situation where you're trying to say, is this company healthy or not, you would look at what they're doing, kind of a trend with their dividends. So this particular piece right here is showing that the dividend trend for Lafayette Life, which
Bruce, can
has
you
to
show
do,
what that top chart, that top bar shows? Okay, there we go.
it's the years. So from 2019 to 2025, which is those 7 years, Lafayette Life has actually increased their dividend crediting rate greater than any other of the companies that we were previously talking about on the rating scale. So underneath them is Northwestern Mutual, Guardian, New York Life, Ameritas, Mass Mutual, Penn Mutual, and then finally Augustar, which I think is interesting.
Was Ohio National.
Was it Ohio National? And they still have a dividend rate that they're doing as of now. That doesn't mean they're going to continue in the future because they did demutualize. But I think this particular chart does show that what we were talking about at the very beginning, just because a company demutualizes doesn't mean you should just get rid of it. So the only reason I brought this chart in was just to show that if the financial, you can deduce it on your own if you want, but if a company is in financial distress, you would think that their dividend crediting average would have been going downward. And in fact, not only is it going upward, but in the last 7 years, it's gone upward higher than any of the other companies that were on the Comdex rating.
And Bruce, something really interesting about that chart you just shared was that we didn't say Lafayette Life's dividend is the highest of all of those companies. What we said was over the 7-year span, they raised it the most, which is why it's really important not just to look at the illustration at the beginning and say, oh, this one is going to outperform all the other illustrations because it has the highest dividend rate. Often you can see a company who shows the highest dividend rate then not have as much room for expanding it up because they're already at the peak of where they can put their dividend rate. And a company that is increasing a dividend rate during hard economic times is going to show a lot of strength rather than one that started out high and then had to lower it or had to not raise it as much. And so I hope that that helps you to realize the value in not just comparing illustrations at the beginning and saying, oh, we know which one's going to outperform in 100 years from now because it shows the highest dividend rate today. That's not the whole story.
Yeah, and I think if you look at it, the one right underneath them that was very close was Northwestern Mutual, and both of them had ratcheted down their dividend crediting early after the financial crisis. So you have the number one Comdex score company in Northwestern Mutual, who's been around, I don't know, Joe's at 175, 180 years,
Yeah.
been around a long time. They're financially responsible. They didn't succumb, just like Lafayette Life did not succumb to the pressures of keeping their dividends high in a low interest rate environment. They did what was fiscally responsible, both of them, and some of those other companies did it to some extent too. But what that's allowing them to now do is increase as the interest rate environment comes up. They're able to increase their particular dividend crediting rates, and so that thus they're in really good financial situation because they were so responsible early on.
Bruce, I think there's something that we probably should address as well, as this is probably a question on somebody's mind who's listening. So we're saying that becoming a mutual holding company is not an indication of demutualization, but we haven't identified what exactly is demutualization. Could you just define what exactly that is and maybe why a company would do that?
Before I do this, I want to just shout out to Warren again because he makes a really good statement. He says clearly with Lafayette Life, the mutual holding structure is not indicative of any capital deficiency, and that was never really the point of the mutual holding company. And this is what thank you, Warren, because this is my whole point of wanting to do this segment today. Is there are people out there that saying the whole point of the mutual holding company is because of financial deficiencies. And that is not the point of it. That is the point of it is so that it makes it easier. Lafayette Life, once again, Lafayette Life was a mutual holding company before they even merged with, for 5 years before they even merged with Western and Southern. So thank you, Warren, for bringing that up. Rachel, now I've forgotten what you had
It's okay.
asked
So
me.
what is demutualization? So
Oh,
what is that if we could define that and then maybe why a company would do that?
so the board would actually determine whether that's in the company and the policyholder's best interest at the time. And in most cases, not in all cases, but most cases, they do it because the regulators have said, okay, your reserves have dropped so much that you have to raise capital. Just as Warren said, there's other ways to raise capital. Joe talked about that, debt promises, so on and so forth. They could do that. But the easiest way and the fastest way would be to go to the public markets to do that. Well, the best way to do it with the public markets is through a company that's already in the public markets. That's a stock company. And so the stock company would then issue shares of that stock to the mutual company policyholders so that they then there's different ways they can get it. They can get a one-time payout. They can get they can get shares of the actual company, or they could also get it in the form of premium payments for like PUAs. So they can get it a variety of different ways. If they want to just take their ball and go home, they can just get the payout. If they want to get the payout in the form of premium in the PUAs, they can do that. So there's a variety of ways they can do it, but basically they would become part of the stock company now.
So basically, would it be fair to say demutualization is the process of a mutual company going public?
Yes, that would be fair to say.
Okay. Um, Now Rob Brayton brings up a question here.
Yeah.
Once the dividends are declared and the option to have them by PUA is selected, what happens and what sort of guarantees may come into play?
I'm just trying to figure out what Rob's actually asking. So let's back up here because I know that some people might have different types of uh, mutual companies or whole life, or more so like a whole life company that's not participating, where or maybe it is participating, but they've set their dividends to accumulate at the company instead of buying more PUAs, paid up addition riders. If that happens, I can hear people screaming through the podcast. I get a bill every year that I have to declare, not a bill, but a 1099 that I have to declare on my tax report that says that I made a profit. I thought you guys said that, these dividends are not taxable. Well, that's because you've actually taken those dividends and they're outside of the contract and they're accumulating at the insurance company outside the contract. And so that interest that they are accumulating then has to be reported on a 1099. What Rob is saying is that when you set the PUAs, and this is what you do for the infinite banking concept with the whole life contract, you set the dividends to buy more paid up additional life insurance. And we've done many a podcasts on that. And what Rob is saying is that now the guarantees that come into play is there's additional guaranteed interest because that's just another form of a premium, so on and so forth. So Rob, I hope that's what you were asking, but there's going to be additional guaranteed interest made on that and additional not guaranteed dividends, but those dividends are now guaranteed as far as the cash value. Joe?
Yeah, I was just going to say if we can, hopefully this helps. When a dividend is declared, it's kind of like at the end of the year, the actuaries get together and they say, well, what happened? And they go through all the little factors Bruce talked about earlier. How was business? We're ahead on that. How are the investments? We're ahead on that. We're below the mortality. We didn't have as much risk as we thought we did. So that creates a surplus. Once there's a surplus, assuming this is a mutual holding company or a mutual company, they declare the dividend and they go back to the owner and say, here's the premium and all the growth attached to the premium. What do you want to do with it? The owner can say, trade it for cash and put it in that side account that Bruce just said. So they will liquidate the premium and the death benefit and such, give them the cash and put that in a side account. That's why it's now taxable. According to the IRS, if you keep it within the contract and just say, give me a one-time adjustment in the death benefit and the corresponding value that creates, the cash value, then it's not taxable. So that paid up, that's what PUA, paid up death benefit is. So you bought additional death benefit that's paid for. There's no future obligation of premium for that. That's why it's now guaranteed. Now the increase, I think what Bruce is hinting at is the difference in the dividend amount reflected in the cash value. So let's use numbers. Say it was $1,000 that bought $5,000 of death benefit. The 1,000 will eventually increase and meet the 5,000. Way out in the future, age 121, but that's the trajectory that dividend is on. It will never equal 6,000 or 10,000. It doesn't keep going up. It's whatever the death benefit was purchased. That's the cap out in 121. Hopefully that clears that up.
And it has to because the actuaries have designed it to do that, to endow or equal the death benefit and the cash value at, in most cases nowadays, age 120 or 121. So that is why, you can say that dividends are not guaranteed, but once declared, they're guaranteed. And then you're also getting dividends on those dividends because of the increase in the basis of that situation.
Okay,
So I think we've kind of
covered the ground
the gamut
that
of this.
we've looked for in this conversation today. So as we're closing, you basically have mutual company, you have stock company, and you have a mutual holding company. Bruce or Joe, can we just recap? If somebody is really saying two questions. A, I'm in a position right now where I'm wanting to start a new policy. And how do I make sure that I make the best decisions so that I can have the best long-term growth guarantees? I can have the stability and certainty. I can do infinite banking in a position where this is going to give me that kind of certainty. And Joe, I'm maybe know you well enough. I know already where you might be going. There's not one policy. We're building a system of policies, so there's not just um, you don't have to knock it out of the park with one policy and have exactly the perfect situation with one policy. But if somebody is saying, how do I make the best decision? Really, how do they take this information about the mutual holding company, stock company to make decisions in getting started?
Yeah, I think a good framework might be to think about, like, if you're sitting at a table and the company's on the opposite side of the table, they have other interests than your interests. If you can, you want to sit on the same side of the table so your interests are all aligned, as much as possible. So in this scenario, my framework would say I would lean way towards mutual way before a stock company. To me, a stock company is like Medusa. It's got 50 heads and they don't know which way they're going. They're banging into each other and they're trying to make right. Whereas this is, we're all in a boat. We're rowing the same direction for each other's good. We're in this together. There's community. There's peace. I can delegate and trust the people to my left to row the same as I'm rowing. It's mutuality. There's no pressure for short-term results to distract us. We're thinking long range. It's a well-run company for a singular purpose. To me, that makes most sense for a foundational element. Now, what you do, like you were saying, a system of policies, your first policy, how that's structured is, I think, a different conversation or the next step in the conversation. But the first part is the company should be on the same side, and the contract provisions should be on the same side of the table. They should lend
Love it.
themselves to you and your control and your flexibility as much as possible.
Absolutely love it. I mean, that's the idea of winning together or losing together. And if everybody's on the same team, you're in a position where the life insurance company wants you to win, you want them to win, you want the other policy owners to win, they want you to win, they want the company to win, everybody wants everyone to win, and because of that, you're all going to win together. So, I think we're going to go ahead and wrap there. And if you are looking for answers in your life, you're trying to make decisions about infinite banking, you're trying to make decisions about anything financial, you're wanting to maximize and optimize your family's prosperity. You want to keep that going as long as possible. You want to have a system in your life that allows you to make the best decisions and have the most certainty. We would love to be a part of that conversation and really helping you move that ball forward or move the needle in your financial life so that you can accomplish your goals and have confidence and peace of mind doing it. So go ahead and go over to themoneyadvantage.com. You can book a call with our advisors there, and we would love to have a conversation with you where we're helping you to understand what best moves can help you make the decision to move forward. And also you're evaluating, are we the right team to work with? And so we're looking together at how can we win together. So with that, we're going to go ahead and close here. Thanks for being with us on the podcast. Thank you to everyone who's commented, including Rob Brayton and Connie Cairn and a couple of others, Fritz at the beginning. So thank you so much for being with us on this conversation. We really appreciate you, our listeners, and we're here to help you succeed. So in closing, please remember, success leaves clues. So model the successful few, not the crowd, and build a life